Hey guys, Dave Santarelli here from the Santarelli Exchange. In tonight's class, we're going to go over how to make money in a bearish market when the market's dropping below the SMAs, simple moving averages. All right guys, so here's the Diamond ETF. Let's take a look at what we're doing here with the SMA. The pink line is the 200-day SMA right here. The red line's the 50-day SMA, the blue line's the 20-day SMA, and the yellow line is the 10-day SMA. This is what we're looking for this week specifically. I made this white box here, okay? And basically this white box is just right above the 200-day SMA, this pink line, and right below this yellow line, which is the 10-day SMA. And basically what I'm looking for here, as you can see, a close above the yellow 10-day SMA, and we should see a short-term climb. And tech earnings is going to play a big role on this. That's going to be a good sign for the market. A close below this 200-day SMA, and that is going to make me worry that we're going to head much lower. Here is how the Dow looked right before the 2008 financial collapse and then right after it started to recover. So as you can see here, this is 2008 before and after the market drop. What I want us to focus on here is the SMAs, okay, the simple moving averages. Specifically, the 200-day SMA, that's the pink line right here. And then the 50-day SMA, that's the red line right here. And I want you to notice this. Once the diamond closed below that pink 200-day SMA, it was a breakdown momentum chart. Just like we have breakout momentum, we have breakdown momentum. Take a look at this chart right here. Just like I showed you, once we have a breakdown momentum chart, which we did not see a market reversal until we closed above the 200-day SMA, above that pink 200-day SMA line, that's when we recover from a collapse or a correction or a market drop. Furthermore, we look for a 50-day SMA red line when it crosses below the 200-day SMA, the pink line, for a market sell-off. That's our confirmation. So going to right now, what I want to show you guys in the market, as you can see right here, a close above the yellow 10-day SMA, that's going to be bullish for the short term here, because we don't want to see this red 50-day SMA come down, 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 and cross below this pink 200-day SMA. If that happens, it's 2008 all over again, and we're going to start buying some puts. So how do we make money with puts? Let's say that the Diamond ETF, the Dow, drops below that 200-day SMA. That's going to be our trigger to buy some puts. And puts are simple, guys. Just like when you buy calls, when you expect the market or a stock to go higher, you buy puts when you think or feel that a stock is going to head lower. And that option is going to increase in value as that stock drops. What we're going to do with these puts, first off, we have to wait for confirmation. And just like back in 2008, I said that confirmation is when that red 50-day SMA crosses below that pink 200-day SMA, the simple moving averages. So once this red line right here crosses below that 200-day SMA, that's confirmation that we want to buy some puts. And we want to buy some puts then that's going to give us some time for that drop that we're expecting. So two things we're looking for, guys. A drop below the 200-day SMA, and for the red 50-day SMA to drop below that 200-day SMA. That's going to be our entry for the puts. That's going to give us confirmation. And once that happens, if that happens, then we're going to buy some puts for a further out expo. So if we feel that the Dow is going to drop, let's say 10% from where it's at, okay? So a 10-point drop, the Dow's at 25,444 now. So that would be a 2,544-point drop. That's a 10% drop. It's quite a bit, but we almost just did that in the past week or two here. So let's take a look. If we buy the 255 strike put for March 15th, 2019 Expo, that gives us plenty of time for the market to move lower if we get that confirmation. We want to capture that entire move lower. And let's just say we only have a 10%. Usually a recession is 20%. So imagine doubling what I'm going to talk about right now. Let's say that we only drop 10%. what's this going to be worth, this 255 strike put? That means these 255 strike puts are now going to be worth $25. So if the Diamond ETF dropped 25 points, that means these 255 strike puts are now going to be worth $25. So if we bought them for $10 and they're now worth $25, that's a 150% return. And that we only need the market to drop 10% from now until March monthly expo. That's plenty of time for the markets to move lower, because I'm telling you, if we do cross below that 200-day SMA, the people are going to panic, there's going to be fear, and that selling pressure is going to continue. So that's what we have to watch for, is the confirmation, which is the 50-day, to cross below that 200-day SMA, and for the market, for the stock, the Diamond ETF, to also cross below that 200-day SMA. So that's what we're looking for, and like I said here, if we buy the 255 strike put right here for $10, that means we need it at 245 to break even, and at 235 we make 100% return, and then at 230 we make 150% return. So that's incredible, and that's what we're looking for with these puts, because when the market drops lower, you can make money with puts, guys, and like they say, up like a feather, down like a rock. So if you buy puts when that market gives us that confirmation that it's tumbling, it's heading lower, that crossover from that 50-day below that 200-day SMA, we buy those puts, and if the market just tanks just 10%, those puts are going to make us 150% return with just a 10% drop in the market, guys. With puts, that can happen very quick. Let's take a look back here at 2008. Let's see how much we dropped. And like I said, guys, this line right here, this little white shaded line here, that's important, guys. If we cross above that, then we have chance for the market to climb during the holiday cyclical trend, okay? And this is important, guys. I want you to understand, because typically Q4 is typically the strongest quarter we have because of the holiday cyclical trend. Usually, stocks, retail stocks usually do very well, but we're not seeing that this year. That's worrying me a little bit. But like I said, we just might be in a little pattern here, a little phase, so I'm going to give it that confirmation that I'm looking for before we start buying some more puts. Right now, I've just been hedging. We bought some retail stocks like Walmart, Costco. We bought some gold that usually do well during Q4, the holiday cyclical trend. So if I don't see those start to rise from now until November 16th monthly expo, then there's no doubt I'm going to be done buying some calls for the short term, medium term, and I'm going to start looking at some more of the defensive stocks, some of the consumer staple stocks, some of the higher end retail stocks that we need like Walmart, some gold, some Boeing is good during a down market. Stocks that pay a big dividend that people need. Head to stocks like Verizon. If we don't have a strong Q4, if by November 16th monthly expo, we do not see some of the main stocks that usually do well during Q4 holiday cyclical trend, that's going to make me worry. We're not going to be buying some calls. We're going to be buying those defensive stocks, gold, and safe haven stocks that pay a good dividend, are good during a bearish market, or times that we're seeing a sharp sell-off. So that's something to keep in mind, guys. If we do cross below that 200-day SMA, like I said, what we want to focus on is some puts on the major ETFs, your Diamond ETF, your Qs ETF. If we just stay right where we are now, gradually head lower, then we want to head into our safe haven stocks and our staple stocks, guys. Those stocks that pay a nice dividend that the hedge funds usually park their money into to collect that dividend during a harsh market. Because here's the thing, guys, even during a bad economy, we all still need food, we all still need water, we need drinks, we need our prescription medications, and we need our services that we use, like our utilities, our lights, our water. And those are the companies that the hedge funds, the institutional funds, will park their money in during a rough market, because when the market's bad, you're still using your lights, you're still using your electricity. You might cut out on going out to eat, and those are the stocks that you're typically going to start buying some puts in during a bad market, because once the economy starts to head south, then people cut back from going out more. They cut back from eating out. They cut back from shopping. So those are the stocks then that you want to start to buy some puts on and start to look at shorting. If the Dow heads lower, if it heads below that 200-day SMA, and if we see that red 50-day SMA cross below that 200-day SMA, that's going to be confirmation that we're going to buy some puts and that the market is heading lower. Like I said, we look at something like the March monthly expo for 2019, and then if we wanted to hold something, if we have larger accounts, we could park most of our money into some of those high-paying dividend stocks, maybe like Verizon, maybe like Duke Energy, Pepsi, or Coca-Cola, Walmart. Those are the stocks that typically still do well, that they pay a good dividend, and larger investors will park their money there. They need those things to survive, guys. You still need your utilities, you still need your water, your electric, your food, and your shelter. So those are the stocks that are going to do well, including your pharmaceuticals. For people that have chronic illnesses, they're not going to say, hey, I'm not taking my pulmonary medication today, I can't afford it, you know? So consumer staples, consumer conglomerates, retail, and like I said, pharmaceuticals. What we want to focus in on this week is tech earnings, okay? Tech is going to play a crucial role this week. If we see tech miss earnings, that's going to be a catalyst for the market to head lower. That's going to put fear in the market. Want a safer stock? Look at a stock like ABX, GLD. Those are your good stocks. Walmart, Costco, ABX, J&J, Johnson & Johnson. Those are the staple stocks that you want to look at during a downward market, a bearish market. I would not be trading this week until we see that tech earnings. I'm telling you guys, please, let's see how tech reports Q3 earnings. Let's see how the market reacts, and then we can trade off of those results. I hope you had a great night. I hope you enjoyed this class. If you like this type of class, we tried something different, please give it a thumbs up. If you didn't like it, just comment below, guys. All right, I hope to see you at the Santarelli Exchange, www.thesantarelliexchange.com. Use promo code CHART for half off your monthly subscription, or if you want a larger discount and sign up for the year, use promo code Brazil, all capital letters. Take care, guys. Have a great night, and God bless.